Imagine for a second that you're standing in line at your favorite coffee shop. You're about to spend $5 or $6 on a latte that will be gone in 20 minutes. Now imagine doing that a few times a week. Most of us don't even think twice about it. But what if you took just $25 of that weekly spending, less than the cost of a single takeout meal? And instead of spending it, you owned a piece of the most powerful information engine in human history. Welcome back to the channel. Today we are breaking down a strategy that is so simple, it's often overlooked. The power of consistent, small-scale investing into a titan of industry. We're talking about Alphabet Inc., better known by its famous ticker, GOOGL. Many people believe that to get rich in the stock market, you need a massive windfall of cash or a lucky break on a penny stock. The reality is much more methodical. It's about time in the market, not timing the market. In this video, we aren't just looking at what-ifs, we are looking at hard data. We're going to explore what happens when you commit to a $25 weekly investment into GOOGL. We'll look at the growth rates over the last 3, 5, and 10 years. We'll compare its performance to the gold standard of the market, the S&P 500. And most importantly, we are going to run the numbers for the long haul, looking at 5, 10, 20, and even 30-year horizons. Whether you're a student starting with your first part-time job or a professional looking to diversify, this breakdown will show you exactly how the math of compound interest turns a small weekly sacrifice into a life-changing portfolio. By the end of this video, you'll see the clear path from $25 a week to a potential 6-figure or even 7-figure future. Let's dive into the data and see what makes GOOGL a cornerstone for so many investors worldwide. What is GOOGL? And why is it important? Before we get into the millions of dollars, we need to understand the machine behind the ticker. When you buy shares of GOOGL, you aren't just investing in a website, you are buying a stake in Alphabet Inc., a massive conglomerate that sits at the center of the modern digital world. Think about your daily life. How many times a day do you Google something? The company's flagship search engine holds over 90% of the global search market share. It is the gatekeeper of information. But it doesn't stop there. Alphabet owns YouTube, the second largest search engine in the world, and the undisputed leader in long-form video content. Every time someone watches an ad on a video like this one, Alphabet is generating revenue. Then, there is the infrastructure. Google Cloud is one of the big 3 cloud providers, powering the back end of thousands of businesses, and recently seeing massive growth due to the artificial intelligence boom. Speaking of AI, Alphabet is a pioneer in the field through Google DeepMind and its Gemini AI models. They aren't just following the AI trend. They are building the tools that the rest of the world will use to create it. So, why do you want to invest in Google specifically? The moat. Alphabet has what investors call a moat. It is incredibly difficult for a competitor to come along and replace Google Search or YouTube. This gives the company pricing power and a stable stream of cash. Diversification. Within one stock, you are getting exposure to advertising, cloud computing, hardware like the Pixel phone, and other bets like Waymo, which is leading the charge in autonomous driving. Cash flow. Alphabet is a cash-generating monster. They have billions of dollars on their balance sheet, allowing them to weather economic storms and buy back their own stock, which often increases the value for remaining shareholders. Investing in GOOGL is essentially making a bet on the continued growth of the internet, AI, and digital advertising. It's a bet on a company that has become a fundamental utility of modern life. How does Google stack up against the S&P 500? To judge an investment, we compare it to the average, the S&P 500 index. Historically, this index returns about 10% a year. That's the benchmark. Google hasn't just met it. Over the last decade, it's often sprinted past it. While the S&P 500 offers broad diversification, GOOGL provides a concentrated dose of high-growth tech. This focus on high-margin software and advertising has driven growth at double or triple the market rate. But there's a trade-off: idiosyncratic risk. Regulatory changes could hit GOOGL harder than a diversified index. If the government passes a new law targeting Google's ad business, the stock could drop even if the rest of the S&P 500 stays flat. But for many, the potential for alpha, those outsized returns, makes the risk worthwhile. Let's look at the numbers.
Disclaimer: before we proceed to the exciting growth data and the investment calculators, we must cover some very important ground. This video is for educational and informational purposes only and should not be considered financial advice. I am not a financial advisor. The examples, data points, and opinions shared in this video are based on personal research and historical experience. Investing involves risk, including the loss of principal. While we will be discussing impressive historical growth rates, it is vital to remember that past performance does not guarantee future results. The stock market is volatile and can be influenced by global events, interest rates, and company-specific news. Always do your own thorough research or consult with a licensed financial professional before making any investment decisions. Never invest money that you cannot afford to lose. Now, let's get into the numbers that make this investment so compelling. To calculate our future projections, we have to look at how Google has grown over various time frames. These percentages represent the compound annual growth rate, or CAGR. 3-year growth rate, 48.38%. This is an explosive number. It reflects the post-pandemic digital surge and the recent AI-driven rally. While nearly 50% growth is incredible, it's often hard to sustain this specific pace forever. 5-year growth rate, 27.23%. Even looking at a half-decade, the growth remains robust. This covers various market cycles, including the high inflation periods of recent years. 10-year growth rate, 25.54%. This is the most reliable number for long-term planning. For a company to grow at over 25% annually for a full decade is a testament to its dominant business model. How does this compare to the S&P 500? As we mentioned, the S&P 500 averages around 10%. If we look at the last 10 years, the S&P 500 has actually performed better than its historical average, returning closer to 12% to 14%. However, Google at 25.54% is nearly double the performance of the broader market. When you double your growth rate, you don't just double your money. Because of compounding, you end up with significantly more than double the final balance. This excess return over the market is why investors are willing to pay a premium for Alphabet shares. It's the difference between building a comfortable nest egg and building true wealth. Your capital investment breakdown, $25 a week. It's important to look at the effort, the actual money coming out of your pocket. By investing just $25 every single week, you're putting in about $100 a month. Over time, these modest amounts add up. In just 1 year, you have put in $1,300. In 10 years, that grows to $13,000 in total contributions. And over 30 years, your total out-of-pocket cost is $39,000. While $39,000 might seem like a lot, it's less than the cost of a single car that depreciates to zero over 10 years. Instead, this is a working asset, earning revenue and building infrastructure in the world of AI and data centers. Next, we'll see how Google's historical growth turns these modest contributions into a massive snowball effect. Let's look at the transformation of that $25. For these calculations, we are using the 10-year historical average to keep our projections grounded in long-term reality. Year 1, your $1,300 contribution is just the beginning. Year 5, you've out-of-pocketed $6,525. But thanks to Google's growth, your account value has climbed to $15,152. You have more than doubled your money in just 5 years. Year 10, your total investment is $13,025. Your balance? $56,805. Now the gap between what you put in and what you have is starting to widen significantly. Year 15. With $19,525 invested, your money has ballooned to $162,178. At this stage, your gains are far larger than your contributions. This is the tipping point of compounding. Year 20. You've put in $26,025. Your portfolio is now worth $348,560. This is a house. This is a massive head start on retirement, all from $25 a week. Year 25. Total invested $28,000. Your growth hits $468,074. The key takeaway here is the acceleration. It took 10 years to get to $50,000, but only 5 more years to triple that. Patience is the greatest tool an investor has. What happens if you double down? If $25 a week can create a $500,000 portfolio, what can $50 do? $50 a week is essentially skipping one nice dinner out per week. It's a small lifestyle adjustment that yields massive financial results. Year 1, your yearly contribution doubles to $20,600. Year 5, you have invested $13,050. Your money has grown to $31,504. Year 10, total invested $26,050. Your portfolio value $113,610. You are now a six-figure investor, and you did it by contributing less than $30,000. Year 15, your $39,050 investment is now worth $324,356. Year 20, this is the life changer. With $52,050 invested over 2 decades, your Google holdings are worth $697,033. Year 25, your $56,000 in total contributions has turned into nearly $1 million, $936,148. By simply adding an extra $25 a week, you have increased your final wealth by nearly $500,000. This illustrates why increasing your savings rate is the fastest way to accelerate your path to financial independence. You aren't working twice as hard, but your money is. Take a look at this wealth ladder on your screen. This is where the true power of scaling comes in. If you start with just $25 a week, you are building a solid foundation of nearly $350,000 over 20 years. But look at what happens when you decide to level up. By jumping to $100 a week, you aren't just doubling your result, you are crossing the $1 million mark. And for those who are ready to commit $300 a week, the 20-year horizon shows a staggering $4.1 million. The most important thing to notice here isn't just the final number, but the total contributed column. Even at the highest level, you only out-of-pocketed about $312,000, while the market did the work to turn that into over $4 million. That is the definition of making your money work for you. The data doesn't lie. The numbers we've looked at today prove one fundamental truth. Consistency is the secret sauce of wealth. You don't need to be a Wall Street genius or have a six-figure salary to build a significant portfolio. As we saw, even $25 a week invested consistently in a high-growth asset like Google can grow into a sum that provides real security and freedom. If you can up your game and move to $50, $100, or even $300 a week, you aren't just saving money. You are buying back your future time. These figures show that with a 25% average growth rate, the numbers work for you while you sleep. But Google is just one piece of the puzzle. In our next video, we are going to dive even deeper. We will explore powerful ETFs like QQQ for tech-heavy growth, SPY and VOO for total market stability, and specialized funds like VGT and SMH for those who want to bet on the semiconductor revolution. We'll compare them side by side so you can see which one fits your risk tolerance, and which one can make you rich the fastest, starting with that same $25 a week. If you found this data breakdown helpful and it gave you a new perspective on how small amounts can turn into big results, please hit that like button. It really helps the channel. And if you want to see our upcoming comparisons of QQQ, SPY, and other major ETFs, make sure to subscribe and turn on the notification bell so you don't miss the next video. Every day you wait is a day of compounding you can never get back. Start today, stay consistent, and let the math do the heavy lifting. Thank you so much for watching, and I'll see you in the next one.